class that, and so what I hope is, by the time we get to the end of this class, that everyone's able to walk away with some tangible tools that they can use. So if you got questions or you want to unmute, this is all interactive too. So it's not, so please interact or unmute if you got a question or something you want to add to this. But yeah, as far as leverage control, Derek, I think I've said everything about that.
All right, let's get into psychological risk management. Now, psychological risk management has everything to do with probably experience. Would you agree with that term, with that? Because in this business, it's a money business. But what I also tell people all the time, 80% of it is mental, 10% is selling, 10% is buying. So what's the mental part? The mental part is what is affecting you to get into this trade? What is stopping you? Like some people, for instance, and I'm glad we're on this, and Kim had this. Let me give y'all a story. There was a guy when I was selling BMWs. He used to be a pit boss on cruise ships for casinos on cruise ships. And he came in and interviewed for a sales job at the BMW store that I was working at years ago here in Clear Lake. And my boss totally timely asked him, he says, so do you have a problem selling a $100,000 car? And he says, well, I don't have a problem with that. I mean, I've been in the pit at night sometimes, and there's $2 or $3 million on a poker table. So he didn't have a problem with it. I remember the first time I gave my first payment for a Porsche 911 Turbo. This was back in 2004. And the payment was like $1,600. So when the manager gave me the pencil, y'all bear with me, I'm going somewhere with this. When he gave me the pencil, I looked at it and the payment was $1,600. Y'all, this is 2004, $1,600 payment on a car. I don't think I've ever seen that before. And the manager said, you got a problem with presenting the payment? I said, yes. You ever had a payment that large? I said, no. Maybe you need to get one if you're going to be in the luxury business. So I ended up buying a car with a $1,483 payment. But I understood exactly what he was talking about. So coming back to trading, a lot of times when people would say they put a couple of $1,000s in an account, and the first time they activate a trade, you got to pay the VIG up front. The broker's going to get their money up front. So automatically, sometimes people, when they see negative $89 starting off, it scares the crap out of them. So a lot of times when we talk about the psychological part of this, a lot of people freak out because this is not somebody else's money. This is your money. And I think the fear of risking your money has kept people out of live accounts. Or it has kept people from, as their account grows, raising that lot size. Kim, can you talk about that for a minute? Because I mean, you had an issue with it, and Miss Connie was very. I remember that conversation. She was very vulnerable, talking about, "Hey, man, this is hard for me. I should have a lot higher lot size, but I'm just afraid." So, Kim, can you talk about that for a minute?
Yeah, as I get into that, let me just as far as physical risk management, as far as psychological risk management, let me just first speak on that, because I think it's about really not about the market, but it's about how we react to the market, with our emotions, and this is gonna lead into the fear of increasing the lot sizes. And so, a lot of times as traders, we tend to lose money when we panic. Sometimes after a loss we panic. Then we're gonna get greedy, like after a win. With me, like if I get something get good, I'm going back again. Or then we just break our own rules. So coming to answer or speak on that, well, it was a big thing for me to increase my lot size because I knew then I've got more capital invested. And if that trade goes sideways, then I know I've got more losses coming from that. And so it was a safer space for me to stay at a smaller lot size. I was still making some money. Now, obviously not making what I could make, but I was still winning and I was still making money and I was still taking baby steps. And a lot of it was just out of fear. And it was emotional because when I still think about psychological, I think about like the emotional part that goes with it. Fear, like either, I don't want to miss out or revenge and I'm gonna, I lose a trade, I'm gonna win it back, or just the greed. So it took me a while to increase those lot sizes to where they should be, based on the growth chart. And then I had to recognize, and I think Eric was the one that really made this point out some time ago in just conversations on one of our classes, is your analysis of the chart is your analysis. It doesn't have anything to do with the lot size. If you have a great analysis or good analysis, whether you're in on a 10-cent lot size or a $10 lot size, it's still the same analysis. So me recognizing that, okay, if I feel good about my analysis, let me follow what my lot size should be.
So speaking of Eric, Eric's in the money business. And Eric, so as you got into trading and you have, probably a sizable account, because of the money that you deal with every day, does the lot size increase bother you, from day to day, or are you comfortable with it?
Initially it took you, I think what Kim referred to was, I said it's all relative, meaning whether you got $10 or you go ahead and you got $10,000 based on the chart, it's supposed to be 6%, right?
Right.
So once I grasped that, oh no, I was good.
Okay. Okay.
But it took me a minute to go ahead and to get there, just because of your point saying, hey, you know what, it's your money. But when we talk about the psychology of money, and you said, hold on a second, you mean you're willing to go ahead and give your money to somebody that you don't know versus, you dealing with your own money? That's crazy.
Right. Right. And I think in this psychological tab here, I think that if everybody's honest with themselves, the more you trade and the more you understand what it is you're doing, the more you read the books, the more you get involved with these conversations and hang around people with like minds, I think the fear slips off. Hey, and let me stop by saying, I'm not telling you to run anybody else's race. You got to run your race. But I'm saying, again, it goes back. If you're not trading, you can't shake off the fear, because you still have the fear of going beyond a place that you haven't been. Y'all feel me on that? Kim, you have anything else to say about it?
Yeah, I do. Yeah. So let me just staying right here on the psychological part and what you just talked about. I think it's a couple of the key parts to this. One is the emotional control, which is what you were just referring to. And sometimes we avoid the trading because of fear of, I don't want to miss out, or greed, or revenge trading. Now, I know I ain't the only one out here that loses a trade and they're like, oh, I'm going back right now. Or what we call hedging, where you enter a trade on a buy and it's going south, so you stay in that trade, but then you enter another trade on a sell. Now, am I the only one in here that has done that in the past?
Yeah. No, man.
Okay, yeah. Emotional control, but then I think another piece of the psychological part is the discipline. Do we stick to our plan? Same risk per trade. Use your stop loss rules. I know we've been talking about stop losses and take profits and trailing stops. and all those things that to mitigate things, no like random decisions, and how that discipline is going to protect your account. So how much do we do we discipline? And then I think the other part psychologically is that we got to accept losses. We are going to have losses. Is anybody on here that has never had a loss in a trade? Because I know I have. Well, y'all know I have. And so as traders, we know we can't avoid losses, but we want to control, like, again, how big those losses are, which is where we're going to get into some other things here, like stop losses and other things that you can use to minimize that. And then I think the other thing with psychological part, I think, is avoiding the overtrading. And I don't know if we've ever really talked about that, Derek, I have been a person too in the past that's been guilty because it got good to me. And I just, the addiction and loving the charts, and I'm just going in, oh, well, this trade's went good, I'm going back and going back. And them times that I go back, I should have sat on the sideline, took my pips, I had met my goals for the day, and I should have just watched from the sidelines. So I think all those factors too also play in the psychological aspect of risk management.
Well, the other thing about speaking about over trading, I don't think there's such a thing if you're doing everything properly, meaning that I'm doing an assessment on every position that I enter. Whether I got in the trade and I was good for it in that trade, I was in and out 3 or 4 times, and then it's that 5th time when you don't do the assessment that when people end up giving the money back. So when you're in for a buy and you're at structure, and then you go in one more time and you're thinking price is going to break through that particular area of structure, and then it rejects. But not only does it reject, but it rejects quickly. So I think over trading is a fatigue thing, meaning I know Kim will trade until she's banging her head on the desk when she's tired, or the fatigue part is, oh, I'm not waiting for this. I'm getting in. I know it. I know it's breaking through. Well, we don't trade on how we feel. We trade on what we know, right? So all those things. I mean, I make numerous of trades per day, right? Numerous trades per day. But the one thing that I have done is I do the assessment every time. And if the assessment at that point says you can't get in, then you don't get in, right? Or if you're tired, then it's time to go. So, I mean, if you're going to trade, you're going to do multiple trades, you better make sure that you're following the rules at all times, because the market does not care about you or your family.
When we talk,
Go ahead.
No, when we talk about over trading, if a person has a trading plan, whatever that said plan is, and say for instance, it's 5, whatever it is.
Yeah.
Are we not, and you have met your plan, and then you decide to continue, or do you believe that does that equate to overtrade?
Yeah, I agree. I agree with that. Because of the fact that, especially if you just starting off, if your plan is, well, I'm only going to do 5 trades today, then just do 5. Don't circumvent the trade. Now, at the end of the week, like tonight, when you're doing your own market review, if you say like, hey man, if you end up with the week and you got 20 trades, and then you go like, hey man, I could have done another 5 or 6, 7 trades, then put that in your goals for next week. So yeah, my thing is I now trade by hours. So my day starts at 3 a.m. and probably about 10 I am done. The only time I get back into a trade if something globally happens. Then I'm back at the trading desk and I am looking to see how that particular impact news is affecting the market. And if there are some opportunities, then I'll take advantage of those. But for the most part, About 10 a.m., I'm usually done. Win, lose, or draw, I'm usually done at 10. So even I have a trading plan. But there are times when, like I just said, when those things, the market or global political events affect the Forex market, and then I take a look at it and see if I could take advantage of some of those things. So what I will say, this next topic,
The psychological part of trading can actually, it got me many a times, particularly when I was starting out, is that, we're talking about we got to get, we want to try to get 20 pips a day, 100 pips a week. And come Thursday, you only got 60 pips. Now, psychologically, I got to make this 100 pips for the week. I end up doing something stupid and, trying to make the 100 pips, not, getting stupid trades. Would you consider that psychological?
yeah, I do, but you have to remember about that salesperson. You look at the mirror, in the mirror, you're the manager, you're talking to that person. And did you do everything you could this week? Yes. So why do you think you didn't hit your goals? And you have to be honest, right? Just be honest. So if you did everything you could and you fell short, that's okay. As long as you don't look, Charlie Thomas used to have us, we had a sales meeting with him every Friday, and he would look at our logs. If we made $1, he wasn't necessarily jumping up and down for the dollar at the end of the week, but we didn't go backwards. He didn't want to see red. And that's the most important thing. You don't want to see red, because Denise, who used to trade with us, she told me something the first event we had in Raleigh. And we were sitting at the bar, and she said, I realized something, that I stopped tripping about the 20 pips a day, because there were some days that I was only going to get 15, or some days I was only going to get 10, but there were some days I was going to get 100. So sometimes, I think you have to look at it at the end of. So let's look at it like this, Richard. Let's say you have 2 weeks where you make 60 pips, but let's say at the end of the month you have 480 pips. Are you tripping?
No, I'm not.
No, you're not. So, I mean, yes, you want to improve. Remember about our book, Atomic Habits. We want to be 1% better than we were yesterday. So you can improve, right? But as long as you're not going backwards, long as there's no red on your ledger at the end of the week, right? I don't want, if your goal is 100 pips, whether it be in your standard account or your savings account, and you look up and Friday night when you're doing your market review and you're doing, you're totaling up your pips, and you look up and you're negative 25 pips, well, that's unacceptable, right? It's unacceptable that if you're only doing 5 trades a week, right? Or it's unacceptable that, you hit your goal with a number of trades that you wanted to accomplish. But if you're negative, then we either have some bad management here, or we have a mechanical issue. So those are the reasons why I encourage everyone, when we're in class, speak up. And maybe it's just one simple thing that can straighten it out. Does that answer your question?
Yes.
Kim, do you want to add anything to that?
No.
Okay. So these 2 subjects here are, I think I could have talked, and we did talk about the positioning size, and Kim hit this really well, right? So I think we've already gone over this part. The stop loss usage. Okay. For those of you who are still gun shy about getting into trades, you should not You should not ever get into a trade without a stop loss. You should have a TP and a stop loss every time. I mean, every time. And that's the discipline part. See, the other thing about risk management, that there is a strong level of discipline that has to be applied here. Stop loss usage, trailing stops, all those things. If you are that person who, man, shoots, I don't want to lose any money, then you need to use your stop loss every time. There should not be a time when you do not use your stop loss. You should use your stop loss every time. And I think with leverage control, we talked about risk per trade. I think we talked about this before. But Kim, is there anything you want to add to risk per trade?
I don't think so. I mean, I think I shouldn't say thing. Let me make sure, when we talk about position sizing and risk per trade, is everybody clear on what is meant by that? As far as, never risking too much on a single trade, and which we have the growth chart, and the growth chart is based off of a 6% daily growth. And I think, you've heard Derek say that it is already aggressive. But is everybody good on understanding position sizing and how much you're risking per trade? Okay. So I don't think I don't think I need to add anything to that then.
Okay. So everyone, it is very important that you get really, really serious about, number one, if you're only doing a couple of trades a week, you're not even trying. So if there's things that you don't quite understand still, then you need to speak up in these classes. I don't need to keep hearing about, Kim, you call Kim, can I talk to you for a minute? I mean that that we shouldn't be hearing that if we are sitting here and asking a question and nobody says anything. Then I'm taking it at face value. That means that everybody understands risk management. That also means that everybody understands as their account grows, so should your position size, your lot size. That should grow as well. And if you are still stuck at a position that you met a month ago and you won't move because you're afraid, then I'll tell you right now that you're not using the stop loss and you're not trading enough. You're not using the stop loss, you're not trading enough. My cousin Benny, when Astroworld was here, there was a little roller coaster he used to like to ride. And I really thought, I still think, I'm 61 years old, and I still think roller coasters are stupid. I don't believe in paying anybody to scare the shit out of me. I don't get it. But he would always ride. Every time we went to Astroworld, there was a small roller coaster he would ride. Okay, all right, I'm ready. I'm ready now for the big ones. So I guess he just had to, get the fear out of the way. And, but that's what our ritual was. I would ride the little roller coaster with him. Then after that, I'm not riding anything else. I'm not riding any roller coaster that drops you from 20 stories and all that crap. But sometimes in order to understand how stop losses work is to trade and put a stop loss in. And frankly, I hope you never have to use the stop loss. I hope you never have to feel that effect of a stop loss. But I'm telling you, once a stop loss is activated, you are happy. Because, like Ken said, trading is a contact sport, ladies and gentlemen. Everybody's going to get hit in the mouth, including me, including Kim, including Richard. Everybody on this call has gotten hit in the mouth. But when you practice this thing properly, the stop loss helps manage losses. So if you are, oh man, I just don't want to lose my, then put in a stop loss. Put in a stop loss. That is another reason, Kim, why I tell people when you first start, you 3 to 5 pairs, know them, study them, so that when you get a pullback on a particular day, this always pulls back here. It's going to pull back, 25 pips, but it's going to return and it's going to hit TP. When IML, when we were in IML, and you would go to those videos and watch those guys trade live, those guys traded live with the same pairs at the same time every week. Why? Because they became experts in that particular pair. What was that lady's name who used to study the gorillas? Well, she became an expert because she sat there with him. And she made notes. And she studied them for years. She was the world authority on gorillas. I can't think of the lady's name right now. But if you're going to study something, you're going to be a master of something, you have to engage. And you have to have structure. And you have to have a plan, i.e., your trading log, your goals that you set up and get ready for, it's supposed to be every Sunday. Or maybe after your market review or your personal market review, hey, man, you know what? I need to probably increase my lot size next week based on my account. Oh man, you know what? Once I hit my goals, I probably should be done. Because right here, I went past my goals. This is what happened. I'm right here, went past my goals. This is what happened. That's why the log is very important. Any questions?
Well,
This is,
before you,
go ahead, Kim.
no, I was just gonna before if there was any questions, but I was just gonna, based on just the conversation tonight, does everyone feel like you have some? When we talk about risk management, do you feel like you have some tools that you can use to mitigate your risk? Some of the things that we talked about tonight, because I want people to leave here with, hey, these are the things that I should focus on. Being consistent with my lot size, trading journal, controlling my emotions, not over trading, not being in too many trades at one time. Does everybody feel good about that?
I do now. I just think I have to practice it in this upcoming week.
See, now, Christy, that's a goal. And you should write that down. That's a goal. That's what we're talking about. That's why we do the weekend review. That's a goal. I like that. Very good.
One thing I would ask, I mean, you don't have to answer, but in your own review or what you do at the end of the week, that going back to that trading journal, and I know it's sometimes hard if you're not disciplined, but it's very important. So how many of us have a trading journal where we're documenting every trade that we're getting in, and then when you get to the end of the week, you're going back and not just based on the trades that you're on your charts or you're on your phone that you win, but you're going back and looking through and seeing, okay, what went well, what wins did I have, which ones that didn't go so well, and figuring out like why. Maybe it's a pair that just don't work. Because there's some pairs for me that just don't work. They work for other people, but it seems like when I get in them with a great analysis, they just don't. And so those are pairs that I just tend to not trade. But documenting those every trade you get in real time is very important. So you can go back and look at that at the end of the week.
The other thing that I would look at in the trading journal, I would look at how many of those trades that failed, right? How many of those trades that failed were trades that you normally don't trade, or pairs that you normally don't trade. You feel me? Like, as you look here, my Intrepid symbol changer, there is no NZD CHF. I hate that pair. I hate it. I hate it. I hate it. Hate it. I don't even look at it. I remember Denise asked, hey, can we look at NZD CHF? No. No, look at it on your I hate it. So, I mean, so I would take a look at that too. And those of you that are bouncing all over the place could be the reason why you're up and down in your trading, because you're trading instruments that you're not familiar with.
Hey, Doc,
Yeah.
how you say don't overlook the obvious. I know for me, it was one of those things that margin and understanding margin, because we talk about being over leveraged, and the way the system looks at it, you get close where your margin starts to go ahead and get down to a certain level. That's a red flag for you. You need to take some precautionary measures. When we
Right.
get click happy, especially in the beginning to a certain degree, you got to know what your margin level is. If you're at a couple thousand, you're in great shape. But if you go ahead and you're down to 200, 300, yeah, we
Yeah.
talk about risk mitigation. You up against it.
Eric, Eric, I'm so glad you said that, because that's a very important point that I did not speak on, but I'm glad you said it because it prompted me. What Eric is talking about is exactly correct. For everyone to have some kind of gauge or be able to see where you are, and this kind of goes to like how many positions you're in. I mean, Derek may not be in one trade at a time, but all of us are not. I am sometimes in multiple trades. I still manage my lot sizes and make sure I'm not over leveraged based on the growth chart. But if you're not familiar with what Eric is speaking of, is what he's talking about is when you look at your phone, you got a category called margin level, and it's got a percentage there. So whenever you get in trades, it's calculating that percentage. If you hit 100%, I don't know what they say, danger, right?
It starts flashing.
It starts turning red, but
Yeah.
I'm trying to think of that movie, Danger. I can't think of it.
Danger, Will Robinson. Danger.
I always get everything mixed up. Yes. So that also can help you in risk management. When you're in multiple positions, you keep an eye on your margin percentage level, which is why, for example, and Derek probably doesn't do this, but there are times that I can be in 5, 6, 7 trades and my lot sizes are minimal, and I'm looking at that margin level percentage, and my margin level percentage is sitting at 15,000, and I'm still good.
Yeah.
And so I don't have any concern. So Eric, I'm glad you brought that up. And as everybody, if you don't know what I'm talking about and you have your phone in front of you, just if you will go to your phone and pull up your trading account for me for just a second, please, so I can make sure you know what I'm talking about. And you're going to see this category, and it's going to show your balance, your equity, but you're going to see a line item that says margin level percentage. Does everybody know what I'm talking about?
Yeah, I tell folks, for me, if my margin gets around 500, I'm paying all kinds of attention, because like Doc said, you can't control the market. If the market all of a sudden goes in the opposite direction, that 500 might go ahead and go to 250. You need to.
Yeah. Yeah.
You're right. You're right.
Yeah.
So yeah. So so everybody, do you know what I'm talking about on your phone? If you go to MT4 and just pull up any one of your trading accounts, you will see that margin level percentage. Does everybody know what I'm talking about?
Yes.
Yes. Okay. So that you want to keep an eye on that percentage. And that's what Eric was referring to. And so as you're in trades and maybe you're managing the trades, and maybe these are either long-term trades or trades are just not going to get in and close out, in an hour or so, that's going to help you gauge, do I have the capacity to add another trade or not? Because when you get into that, when you get to 100, as soon as it goes beyond 100, like 99, everything go red and the broker will start closing trades for you. So that's another tool that you can use for risk management to manage whether you're over leveraged or whether you're in too many positions.
And there's
Eric,
another
thank you for bringing that up.
there's another thing about this too. So if you're in multiple trades, and let's just say the market goes bananas. Let's say you're in trades from the London session and you're about to go into New York. Well, most times the spreads will increase going into, or when a when trading session is about to close, spreads go up, And then when you're about to enter a new session, the spreads go up. And if that happens, that could also affect your lot management. Because if the spreads go up and you're in multiple trades, if you're over leveraging, you might get taken out of there. And it has nothing to do with news or bank move or anything. It's just the money got more expensive. So those are things that you have to think about. So I want to show this last thing here, and I put this this trend line here, and we talked about this before. So one of the things that when I was coming up, and they would say, well, when do I get into another position in a trade? Well, Dr. Spiller used to say, well, every 20 pips you should put a position in. Well, I got a little bit more conservative. So let's say we enter the trade here. So from here, why is this doing this? Don't mess with me tonight. So from here to here, right? Let's just call it to right here. I have 557 pips on position number 1. So as price moves up here, I see another flat bottom. Why are flat bottoms in this case on the bullish candles important? Because they either signify a start of a trend or they are given a continuation of this trend. So when I see a flat bottom starting, right? This will be position number 2. So we take position number 2, it goes all the way up here. That's 323 pips. Hope somebody's writing these down for me. Okay. So the next pair, here's another flat bottom. So we take this from here. Jesus. So we take this from here to here. Why is this doing that? Okay. So that's 222. So then I see another flat bottom, right? That's 128. Here's another flat bottom. So that's 93. So how many positions was that? Nobody was. Okay.
I think it's fine.
But did anybody write down the pips?
It's about a little over 1,200.
So, okay, so we'll use that. And let's say the average lot size was, okay. So let's say here that my lot size is $20 here. My next flat bottom, instead of doing 20 here, I'm going to do 10. Right? And instead of doing 10 here, I'm going to do 5. Instead of 5 here, I'm going to do 250. And here, I'm going to do 120. So if you average those out, let's just say the average is $12. It could be higher or it could be lower, but let's just use it $12. So $12 times 1,200. What's that? That's okay. I got it.
That's $14,400.
So $14,400. And this trade started on April the 6th. And we're using this here, and it started or ended April the 17th. So 11 days. 11 days, and you've made $14,000 on one pair with 4 or 5 different positions.
Can I ask you something about this?
Sure.
So I know we talked the other night about long-term trading and kind of went through the same, process of multiple positions. Can you help me understand? So if we're looking at a growth chart, and I know we had this conversation the other night, but if we're looking at the growth chart and it's got a set lot size there for the whatever that is based on the amount that you have in your account, can you explain how we can get in? Just based on what you just said now, how are you able to get in these multiple trades and not have high risk management, over leveraging, or issues of maybe losing trades and blowing the account?
First of all, it's all relative. If I'm looking at a long-term trade, and what did I say the other night? I wouldn't be looking at a long trade unless I have $700 in my account.
Yes.
So that's why I'm cutting them in half. Now, it could mean, right? It could mean that, and I think at $700, I think our pip size was what?
0.21.
So $2.10.
Right. But it's your total lot size. Right.
Right. So then, if I'm not in any other trades,
Mm-hmm.
that's $2.10. Right. And I think when we did this, we cut that in half, to the point that I think at this last position, we were at 10 cents. Now, what that means is I can't go and look at gold and get in a gold trade because I'm maxed out.
But my question, we were maxed out at trade number 1 if 0.21 is all we can do for $700. So what I'm trying to understand is how can we do position 2, 3, and 4?
Kim, you're looking at it literally. I'm just giving an example. But of course, if I'm looking at a long-term trade, what was one of the things I said in the class? I said that I have to go at least half or lower than half if I'm looking at a long-term trade. Now, I've got in long-term trades over the last 3 weeks, and $20 lot size in this one particular account was not even close to my standard account. Why? Because I have to prevent from what? The pullback. So look, if we're talking about long-term trades and we're talking about lot management, we could combine these two classes tonight and say that if I believe I am going into a long-term trade, I have to reduce my lot. I was just given this example here of what it could be and how you have to do it if you start. So if you start here, and let's just say the $2.10 in this example is a minimum, right? It's a minimum. Let's say I got a 10,000. Hold on. Let's say I have a $10,000 account and I start at $5.
Mm-hmm.
I'm well under what my lot size is.
Absolutely right.
Okay, so I'm just saying it's all relative. So if somebody's got a $700 account, and they probably need to start here at 10 cents, or maybe 20.
I just want to, that's what I wanted to clear because
but I'm just using a hypothetical here. I said, what if you wanted to use $20 here, and I'm just cutting it out in half. I'm not using it literally. You're using it literally.
Oh, right, but I want to make sure, because I want to make sure everyone, because I took it that the way that you explained it.
Of
and
course
make
you're
sure-
going to take it literally, Mom, because you watch every freaking penny, and well, you should. I'm just saying. I was just giving an example about risk management in a long-term trade. I didn't mention how big my account was.
Okay.
I
So
was
what you're
just what I'm saying is this literally. If I decide at $20, this is what I want to do. I am literally saying that my account could handle a lot more than 20, but I am starting 20 here because of the fact that my standard lot is probably $200, but I'm starting at 20 so I could be in the long-term trade so I can handle this, the pullback. So I can handle this, right?
Right, understand. Right. So if I could just summarize, and then I'm gonna go on mute. What you're saying, going back to the $700 balance that we
No, I don't want to go back to the $700 balance. That has nothing to do with the example, Mom. I was just go ahead.
What I'm trying to make sure that's clearly communicated is based on whatever the balance is in an account, whatever that lot size is that you are to use. If you're taking multiple positions, you still can't exceed that lot size, whatever it is. Is that correct?
That is correct.
Okay.
And I mentioned that in the long-term class. I am probably going to go less than half the lot to combat the pullback. Now, ladies and gentlemen, I mean, we're getting a little off topic here, but if you get to another flat bottom candle, that doesn't mean you have to take the second position. Just because you see it doesn't mean you have to take it. Y'all feel me on that? No? Yes?
Yes.
Okay, because it's not a golden rule anywhere where it says that you have to take a second position in a long-term trade.
Eric, I
Hey,
sweetheart. The other thing I recall from just to be clear, the other day when we were talking about this, you said we're not doing this in our savings account. And
correct.
so about lot sizes and you talked about so I just wanted to, I think that's
Yeah.
what
You're definitely not.
the confusion here is like, hey,
I
lot
don't.
size.
There, ladies and gentlemen, there is no aggressive trading to be done in your savings account. It's 20 pips a day. If you secure your 20 pips and with a trailing stop and it continues, then sometimes it'll run for another 20 pips or 30 pips. But in your savings account, it's 20 pips. Right? That's the goal. In your standard account, you can trade all kind of things. You still have to follow the rules as far as risk management is concerned, but you are not doing long-term trades in your savings account. Everybody understand that? Like, you shouldn't be in multiple trades in your savings account, because then that risk that what Rich and I were talking about earlier about it going backwards, and we don't want to go backwards. And I also think long-term trades are an advanced conversation. And I think it's pretty clear that we need to have advanced conversations in a separate class. Because, Rich, when we talk about the English, using English,
Yes.
I use a lot of English in my aggressive accounts, and we'll talk about those. All right, y'all. Again, like I told y'all, this is always a spirited conversation because we're talking about different philosophies when talking risk management, and what people think is risky and what some people don't. My thing, I think 6%. Here's my philosophy, and it's just the math. You are not. And we're talking about operating within a reality. But anything less than 6% is not going to get you to those goals. It'll get you the goals, but not the goals that are on the growth chart less than 6%. It's just not going to happen. And I think 6% is a very manageable goal if you're using the lot sizes that are on the growth chart. If you exceed those lot sizes, then again, you are blowing up the premise of the growth chart in that sense. All right. Any other questions? All right. Again, this is always a spirited conversation. I welcome the conversation, and I hope everybody learned something from this. And we'll probably do this again, next quarter, or even better. What's the next event? Is the next event Houston?
Yes.
Yes. Yeah, we'll talk about this at the Houston event, and we'll probably use 2 blocks to do that. All right, y'all. This is
Reinforcement.
you can bring anything you want. Anybody want to
What?
anybody want to compare accounts at that event? I'll be more than happy to do so. What's that?
Rich, I'll be ready for him. I got you.
All right, y'all. Y'all have a good night.